Hello, everyone, and welcome to the show. I'm your host, Hiran Amin. Many investors have likely heard of the famous old adage, buy low, sell high. In many ways, it's the holy grail of investing, getting more for less. Yet, it's often easier said than done. It can be tough to find the courage to invest in a company that's seen its business struggle and its share price tumble. But sometimes those unloved stocks can offer significant upside if they can turn things around. That's what contrarian investing is all about. Having the conviction to go against the perceived wisdom of the crowd in search of higher returns. Of course, a contrarian needs a lot more than just courage. It can take a lot of time, effort, research, and most of all, patience to identify these contrarian opportunities. We're going to get some help from an investor, and I quote from the Globe and Mail, who's widely regarded as Canada's top authority on contrarian investing with over 4 decades of experience. Joining us today is Benj Gallander, president of Contra, the Herd Investment Newsletter. Benj, thanks so much for being here with us today.
Oh, it's an absolute pleasure. I appreciate the invite.
Oh, you're definitely welcome. So, Benj, before we get into the meat of our conversation today, I wanted to just pick on a couple of things just to get to know you a little bit better. Contra the Herd, where did that name come from? How did you guys land on that?
So it's spelled Heard, but it's a bit of a play on the word because, of course, there's also Herd. And we do go against the herd itself. We are often looking in the other direction, trying to find stocks that are unloved and that we think can recover. Herd, Heard, of course, is listening, and we really want to listen and get information. So it just seemed to myself and my business partner, Ben Stademan, that it made sense to have a word like that, which works in both directions.
Now, let's get to our conversation today. So, before we dive in, a quick note for our audience. We are discussing Benj's approach to contrarian investing and some of the specific criteria that he uses. However, there are many ways an investor might evaluate contrarian opportunities. So, take our discussion as food for thought rather than financial advice that's broadly applicable to all. All right, Ben, so let's get into it. The first and basic question we want to ask is exactly what does it mean to be a contrarian investor?
Well, effectively, we're going against the grain. So when stocks are out of favor, markets are out of favor, that's when we like to dive in. So in terms of what I do, it actually includes a lot of different systems at the same time. But we're buying the unloved. We're buying often the despised and the hated. Of course, we do a tremendous amount of research to try to confirm that we believe that the stock can indeed turn around. So we look at things quite differently. There's no question. It's not for everybody. You have to have a certain stomach for it. But it is a question of looking at markets and stocks in a different manner. It's almost an inversion as compared to what a lot of investors do. We're deep value investors, there's no question about it. The system we use is combined with other systems too. We love momentum. We invest when there's no momentum, but say if I buy a stock at $1.50 and it goes over 5 and over 10, then some of the mutual funds and the brokerage firms can start suggesting that company or buying into that company. So we get the momentum from them to have higher returns. So it's the system I use, and it's outlined in the books. It's how I've combined a lot of other systems.
Yeah. And that's a good explanation you have of that. Now, with any investment approach, that it has its inherent risks, but also benefits. So can I get you to maybe spotlight potentially what those are for contrarian investing?
Well, with the turnaround, you've got a much better potential for better return. So that's critical. If I'm buying a stock that's traded at $15 and it's now at $2, and I think it can turn around, and if it traded at $15 for a long time, I'm going to have a higher overall return. But again, the key is to try and avoid those stocks that are going to go bankrupt. So one of the things I don't do is try to catch a falling knife. There's a danger that if you do that, the stock will just keep on going down. And I recognize that often I don't have all of the information or as much information as other people. So what I try to do now is wait until the company's stock price is stabilized or has actually gone up to some degree. By doing that, it means I get rooted by far fewer stocks, and that's absolutely key. I mean, as you're saying, there's no system that's perfect, and a lot of people think that contrarianism is far riskier. I personally don't think so because we're very patient before we buy. Before we buy, I'll wait at least 6 months, often years. But doing this for over 40 years, I've certainly learned from my mistakes. And over time, I've made less mistakes, but I still make some.
Mhm. All right. Now, for those of us who kind of want to get into contrarian investing, what kind of investor profile would we have to have that would have the makings of being a contrarian investor?
Well, you have to be willing to go against the grain, which means you often have to deal with criticism.
Mhm.
When I first started and I wasn't known, and this is 40 years ago, a lot of people would wonder why I was buying into these companies that were so badly beaten down. So you have to have a certain stomach for it, a certain fortitude effectively. And that's absolutely critical. In our case, we also have a tremendous amount of patience. I always set an initial sell target, which is always much higher than the price that I pay for the stock, but I'm willing to be very, very patient. Sometimes it takes over 10 years for these stocks to do the turnaround that I expect. But if you're getting 3, 4, 5 times what you pay, you still get an excellent return. I think it's critical that you gather information from a lot of different sources. Um, I think it's important that you talk with other people who may know about the company. I read a lot of other sources. I do a lot of reading online. So continually reading and adding to the information that you have is critical. And again, giving the negative information a certain amount of possible credibility that may steer you away from the stock. A key thing is continually reviewing the stocks, but not getting scared out when they don't turn around as quickly as some people might like to see.
Mhm. I know you said having a strong stomach for, I guess, for that volatility and risk, and that actually leads me to my next question. We've been grappling with bear markets, heightened market volatility as well as going on, and then there's a bit of economic uncertainty, of course, so far that we've seen in 2023. So, what sort of market conditions have you found that tend to play in a contrarian's favor based on your experience?
What I love to see, and that's a great question, I love to see markets that are badly beaten down. Of course, that's the time that most people will not necessarily want to invest. So if they are badly beaten down and people are exceedingly pessimistic, that generally bodes well for us. At the same time, as I alluded to before, I'm looking at stocks that have been badly beaten down. So if I can have both of those conditions, I've got a much better chance for outsized returns.
When you talk about markets being down, there's often we hear the word that's thrown around is value traps. So how do you kind of navigate that, especially because everything seems of value usually when markets are beaten down potentially. So how do you go about that?
Yeah, and as I was saying before, when I would make more mistakes, I would sometimes get caught in the value traps. It rarely happens now, but it still happens. So you have to be very careful to do a lot of analytics, which is why I'm looking at book value. I'm looking at the debt the corporations have. I'm looking at the management the corporations have. I'm doing a tremendous amount of ratio analysis. So by doing those things and by doing it patiently, it helps me to avoid some of the value traps that are out there. And I would say for people who are just getting involved in investing, you want to make paper trades so that you can see how your system's doing. You want to learn. You're going to learn a lot from what you do well, but you probably learn more from your mistakes. And it's absolutely imperative that you evaluate those mistakes and take the time and don't just try and push them under the rug and say, oh, this is awful. I hate it. I quit. Look at them and say, okay, what have I learned? And then move forward with the new knowledge.
Yeah. I like how you said setting up that system. Now, you in fact have a rating systems for stocks that help you kind of prioritize the potential contrarian opportunities you're considering and manage the risks you take as well. So, could you take us a little bit through how that system works?
It's 1 to 4, which means a 4 will put twice as much money into a stock as with a 1. So if a stock is iffier, higher risk, we'll often put in 1.5. If we feel it's more solid, that there's going to be a turnaround, we'll put in, say, 3.5 to 4. So by doing this, it knocks the risk level down to a certain degree. It still allows us to buy some stocks that do have a higher risk element, but not as much money in them. Often those stocks have a higher potential upside amplitude. So that can lead to better returns.
Yeah. Now, before you even kind of, I guess, get to this rating system, one thing that I'm always curious about is we need investments to evaluate using that system. So, what are some of the specific criteria that you consider when researching contrarian opportunities?
So I look for stocks that are badly beaten down. So I do a filter, and the stocks that have been, again, really hurt, they have to be beaten down by at least 33% before I even look at them. Now, it can be 50%, it can be 75%, but 33% is the absolute minimum before. And then again, I'm always looking at the stock going up at least 100% for me to buy into it. Whether the stock price can double, triple, quadruple, or 5 times, that's worth a lot of points. One thing is the management, that's worth a point. The debt levels, that's worth a point. Or it can be a negative point too, actually. Um, Insider trading, that's worth a point. Whether the sector is out of favor, that's worth something. If the number of shares in the company has gone up dramatically, that's a real negative. I like to see stability, or that the company's perhaps buying back shares and buying them back at a reasonable price. Too many companies buy back shares at a much higher price, and that doesn't make sense. If the stock price has gone up, that means the potential upside is less, which means it will get less points for the upside. So I've actually I've put a chart together, an Excel spreadsheet actually, and I fill that in. I like to see a minimum of 10 points. Often there's 13 or 14. If it has under 10 points, it's very rare that I will actually invest in the company. I then take those, I contact the company, ask them to send me more information. Sometimes they will, sometimes they won't. Of course, I do a lot of the research on the internet. And then I'll sit for a minimum of 6 months before I'll invest. So within that, it's kind of a vetting process unto itself. Often, as I said before, I'll take 3 or 4 years, often over a decade. But it's very, very crucial not to just jump in.
What is your process of monitoring that stock then over time?
I have Christmas buys. Those are the ones I'm closest to potentially buying. There's about a dozen, but I buy very few companies, maybe 5 in a year. Then there's AAAs in baseball. These are the guys who have a lot of potential. AA, less potential. So I like to see, I actually have companies graduate. They always come on as AA. And then if they look like they're turning around, I move them to AAA. If they look like they're turning around more, I'll put them in the Christmas buy category. So by doing that, I familiarize myself over time with more and more of the companies. But every day, or virtually every day, I look at which of the companies I have that have some sort of news, or they have some sort of results. If they do, often there's a webcast. Often I'll listen to the webcast. Sometimes by listening to the webcast, you get other ideas. You hear other things about that specific company that you don't see in the written material. So that can be very, very helpful in terms of guiding an investment. So I really like the webcasts. Sometimes I'll read them, but usually I will listen to them. I find that's more worthwhile.
Let me go back to the point system. One of the things you talked about was having a point for, or assigning a point, I should say, rather, to an investment that can potentially double its value. So, how do you go about estimating the potential upside of a stock that you're researching?
So I'm going back at least 10 years on each of the stocks and looking at where they've been trading in the past. I don't buy anything that hasn't been around for at least 10 years, so that helps to reduce the risk. So if I see a stock and say 7 of the past 10 years, it's traded, say, 3 times the level where it is now, I will often focus for the initial sell target to be 3 times the level where it's at now, maybe plus 10% given the time frame. But none of this is pie in the sky. It's all based on where the stock's been before.
Benji, you kind of mentioned about this qualitative and quantitative measures to look at. So let's focus on the qualitative side of things. There's a lot of emphasis you place on a company's management team when deciding whether to invest in them. So why is this so important in your view, and how do you evaluate their performance?
So I look at their track record. So if they've had success with other companies, that's often an indicator of success with the company they're with now. I also look at what they're promising. Often management has a time frame. We want to do this within a year. And if they do it in 6-8 months, so much the better. If after a year they're not close to it, you have to wonder what's actually going on. And then with the management, you want to see stability. There's one company I actually own, and literally they just got rid of the CEO. But it's not like the CEO is leaving in 2 weeks or a month. They said the CEO is gone today. So if you see a CEO or a CFO who is gone immediately, that's a major red flag. And then you have to rethink the operation and say, well, maybe I shouldn't own this company, or I certainly don't want to buy it until I know who the new CEO is and until he's got his feet wet a bit.
Okay. Yeah. So keeping those goals and promises in line is kind of one of the key things you look at. Now, on a similar vein, let's switch over to the quantitative measures. You do carefully also examine companies' financial statements during your research process. So, what sort of trends suggest to you that progress is being made from that lens?
Well, often I look at debt as being absolutely critical. Sometimes we're buying into companies that have been beaten up but have no debt, which I love. Sometimes the company has been overburdened with debt. I'm looking at debt coming down. That's absolutely critical. I like to look at the current ratio. So that means they can cover their debts due within a year. I like to see that they have a reasonable amount of cash. Some companies don't have a lot and they operate that way regularly. That increases the risk. But if a company's been doing poorly but still has a lot of cash, if it's been losing money and you look at the number and you see, wow, they've got enough cash that even if the losses stay at this level for 3 or 4 years, they've got the money there. I don't like to see a company with high interest debt, because that's an indicator of negativity. If they have debt at 10% or higher, that's often a very bad thing. What's going on with the revenues? I will buy into companies with decreasing revenues, but often I like to see they've stabilized or gone up. And of course, there's that thing called the bottom line. If the company hasn't been profitable in a number of years, I like to see that the red ink is not as bad as it used to be, or perhaps it now has black ink. So at the end of the day, you generally want to see a company that's profitable. I will buy into unprofitable companies, but for the most part, they'll have been profitable at some point in the past, often for many years. Another thing I like to look at, and we haven't touched on, is insider trading. If a lot of insiders are buying, that's a good time to potentially buy. If a lot of them are selling, that's often a negative indicator. So some systems I know are virtually completely based on insider trading. And if insiders are buying, you buy. That is just a component of the system that I use.
All right, Benj, and can you take us through an example of how you have applied your research to find a contrarian investment that has paid off for you in the past?
So one company is one of the major American banks, which we actually invested in twice. And the stock price had been over $40, $50 in the past. And now, because of the banking crisis in the States back in 2008, and also in the late 80s, uh, the company had been absolutely killed. So initially, I started with the logic that the American banking system was going to continue. The key was to avoid banks that would go bankrupt. So I looked at this company and I saw that it had traded at 7 times where it was now. And I had a lot of faith in the company. If that company had gone under, it would have been horrible for both the American banking system and the global banking system. So I was buying in at very, very low price, single digit, and charting it again at a much, much higher price. Now, if you're looking at a initial sell target of 5, 6, 7 times, you can't expect that to happen in a short period of time. You have to be very, very patient. And that's effectively what I did. Now, another part of this that I like when I buy a company is that the company has dividends. If the company pays a dividend, that allows me, as I like to say, it allows me to be stupid longer, because often the company doesn't do anything, but at least I'm getting a partial return on my investment. So again, that whole banking system was getting killed. What were some good companies in the sector that I liked? And at that point in time, I bought into 5 or 6 banks. Now, what that also did was it spread the risk. So instead of putting all my money on one jockey and one horse, so to speak, I put in a number because in case I got it wrong. And by doing that, I was far more assured that overall I would have excellent returns, which is what happened.
Thanks for sharing some of your research criteria with us, Benj. Now, before we continue, I wanted to take a moment to show our viewers how they can use the Screeners tool in WebBroker to help them narrow down their own research. So click on the tab that says Research under the Tools column. We're going to head over to Screeners. We've already got this loaded up, so I'm just going to click off the page here. And to begin that, we're going to click on the screening tool here. And this is going to allow us to really start adding our filters or criteria. Now, what I'm going to do first is I just want to clear out anything that's in there that we don't want. And I'm going to narrow down my search to just kind of restrict it to our Canadian market and particularly just focus on the Toronto Stock Exchange. You can, of course, choose any other market that you wanted or any particular sector if that's what you want. Now what we're going to do is I'm going to turn on this bulk edit. I like seeing all the criteria added all together in one section. So I'm going to go to more criteria and go ahead and choose the ones we want here. So to begin with, we're first going to look at the stocks that have their prices being depressed over the last 52 weeks. So we really want the ones that have gone down. So I'm going to add price performance over 52 weeks to begin with, and we'll add the criteria in just a moment. And then we're going to add dividend yield here because this is just a nice perk to have as part of these value opportunities that we have. If it has a dividend on there, as Benj mentioned, it allows us to be a little bit stupid for longer there. And then we're going to focus on some of the now metrics or ratios of a company related to its debt. So we're going to first go ahead and add the current ratio in, and we'll explain what that is in just a moment. We're also going to go ahead and add in the debt to equity ratio. And then finally, we also want to be able to add in the price to book ratio. All right, and so these are the starting criteria we have chosen to get us going over here. Now, what we're going to do is we're going to just work our way from the top to the bottom. So price to book ratio, what exactly is that? It really tells us how much of a price investors are willing to pay over the book value or net worth of the company. So we wanted to kind of cap it to 15 times the amount of the book value. So we don't want to pay any more than 15 times its book value as our measure of criteria. Now, again, this is going to be really dependent on the sector and industry you choose. So really want to balance that out. The debt to equity ratio measures or tells us, and if you can hover over it, it tells us about the leverage of a company. How much debt or how leveraged is the company in terms of servicing its long term debt? So it's essentially taking all the total debt or liabilities and dividing it by the equity that's part of the company. So here we wanted to kind of cap it to say that it's not taking on more than about 1.5 times its equity there. The current ratio measures the immediate need or the liquidity of the company in terms of servicing its short-term liabilities against its short-term assets that it has. And so here we want at least the assets to be at least more than 1.5 times the liability. So in case there's a sort of crunch, they do have enough assets to keep operations ongoing there. Dividend yield, you can pretty much pick what you want here. We're going to use 2% as our minimum benchmark. We want to at least see a 2% dividend. And then finally, price performance, which is kind of that starting criteria. We want to see prices depressed. We want to start off our search at least being down 25% over here. I'm just going to make sure we've chosen 25%. There we go. Now we've got, once you've added this criterion, you're going to see your results being populated over here. And it's kind of ranked based on the criteria. So from here, the investor, you can choose to kind of sort it out based on different criteria that may be more important than others. And from there, you can really do your research. And this is just a starting point for those who are looking for deep value investing opportunities, some considerations to have for yourself. All right. So one thing I wanted to ask, how do you decide to sell out of your position, both when an investment has worked out and when it hasn't as well?
Okay, so selling out when it's worked out by setting an initial sell target, I ground myself. So I'm setting the target before I own the company. And then generally I'll stick with it. And with that in place, I will often sell 50% or more at or near the sell target. So right off the bat, I'm trying not to get caught up in any of the hype that may be going on, positive, negative. Um, so that's critical. So going from there, setting a secondary sell target is a little more difficult because after that, I will be looking where I might sell more, and that's a little bit less defined. Again, I'll still use historical valuation. And sometimes I'll just wait. If I notice, say, I've got a company and in April, it's at the target, but I see in 7, 8 of the past 10 years, it goes higher, I will often wait. I won't generally do that at the end of the year in November, December, because I want to do this thing's called tax deferral. If I can defer the gain to the following year, that means I keep the money longer, which means I pay the powers that be, Revenue Canada, later, which allows me to make more money over time. On the downside, it's just if enough things start going against the stock, I could go out for that reason. I will not sell a stock because of the economy, though. I just won't bother to do that. I will wait until the economy turns, which we all know it will turn at some point, and I'll stand fast. I do most of my tax loss selling in May or in the spring. A lot of people do it in December. The problem with December is that's when a lot of other people are doing the tax loss selling, which means the stock is going to go down more, that old supply demand thing. And that's when Benj Gallander is doing his buying. Now, another thing I like to say is don't fall in love with any company. They don't love you. Why should you love them? And too many people do not want to admit when they're wrong. And I admit when I was younger, I was far less likely to admit that I was wrong. But now, having been beaten back and forth more over the years, and I guess maybe simply because I'm more confident in myself, I'm more willing to just say, you know what, I've made a mistake here, get out, take the loss. I always have gains to write it off against, hopefully always will. and then I'll keep following the company and look for potentially a turnaround in that company to buy back in.
So thank you so much, Benj, for spending the time with us. We're going to leave it there for our conversation. This approach certainly we can appreciate isn't for the faint of heart, and it can require a lot of research to really support it. But it also sounds like the rewards may be worth it. So, any kind of final thoughts you'd just like to share with our viewers there?
If somebody's thinking of doing it, what I would do is step in with a big toe and maybe a small toe and then a big toe before going in more and gradually try it on. And I would say just that with any system. So not jumping in and again, continue to learn. Absolutely critical. And you will learn, as I said, from what you do right and from your mistakes.
All right. Excellent, Benj. And, thanks once again for spending time with us. And for those of us in our audience, please make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. Until then, see you all next time.
Thank you.